Good evening, friends. Somebody asked me what is static liquidity and dynamic liquidity. I'm going to explain the mechanism of these two words, why we are using static liquidity and why it is important for us to note. See, for retail traders, there is plenty of liquidity. Plenty of buyers and sellers are available because the quantity what we trade, what a retailer trader trades is very less. Say, for example, as an individual, if I am going to buy or sell the stock or an indices easily, for me, if I want to buy easily, one seller will be there ready to give the stock or any option entity or the futures or future contracts or anything, right? Whereas the big financial institutions will have difficulty. Difficulty. Why they will have difficulty? Because they have huge money. Huge money. So the market functions between the big players and also medium type of buyers. So you might have heard about foreign investors, FIIs, DIIs. So the part of it is facilitated by the buying and selling between the FIIs and DIIs. So suppose you might have noticed foreign investors sells this much crores of worth of contracts, whereas DIIs will buy the contracts against. But it is not sufficient for them to completely absorb or exchange their whole lot of money because they will not be having that much of. If they want to sell, there must be buyers should be there. Or if they want to buy, there must be sellers should be there. For that, market, how it functions is, see, market trades in what type of market structure you are seeing is trend structure and range structure. So when ranges are created, when the ranges are created, so equal low and equal high are created. The reason for this is all the retail traders will think it is a strong support. For example, over here, in this area, say equal low has been created, right? So when you create an equal low, what you are going to do? The risk management. Retailers will do risk management. If it goes against that, I'm going to sell. So these are the sell stop losses are pulled over here, right? Sell stop losses are pulled over here. Lot of money, that is passive money, has been kept. So nowadays, even the brokers also provide this data to these big financial institutions where the sell stop losses are provided. And also it is the area where stop losses are kept. So this is passive money. What it happens is when big money, if they are selling, they will absorb this, all these sell stop losses, they will buy. When they buy sell stop losses, they get charged. They get charged. Why? Because their their money is converted. It has been exchanged with all the sell stop losses. And then they have to put extra money. You must understand this. They have to put extra money to buy all these sell stop losses. When they buy all these stop losses, they push the market down. See, later, they have to mitigate it. See, when they bought all those things, they will be in drawdown, right? Again, market creates a range. And equal high has been created over here. See, multiple times you can see here, equal high has been created and buy stop losses were kept by the retail traders because it is an inducement. See, the market rallies and retailer, Nalinakshi is saying that it is a resistance because I'm seeing after two green candles, I'm seeing red candle, right? So I'm going to, by seeing this, what I do, I will go for selling because it is a resistance and I will keep a buy stop loss over there. So like I'm not the only one. Like Nalinakshi, thousands of Nalinakshis will be there in the market. Even 10,000, even 1,00,000 Nalinakshis will be there and their stop losses will be kept. They will be induced. So they are induced. I am induced to sell, but it retests this and it doesn't take the buy stop losses over here. Okay. And again, market comes down. They take time. The market comes down. It creates an equal low. So equal low, static liquidity has been created. That is, sell stop losses will be created. So here, buy stop losses have been created and sell stop losses have been created. So market, what the money, who can push the market up? The big player pushes the market up and it swallows all the, you can see this candle swallowing all the buy stop losses, crossing above the equal highs, you can see, and going above this level, all these buy stop losses will be will be exchanged. See, market is like that. It goes and it gathers again, gets recharged because they get mitigated, because they have put extra money invested over here by buying all the sell stop losses over there. So they get mitigated. So they are not in drawdown. They have come up. And now they are in profit. They are not in, by putting lot of money, they push the market higher and now they are in profit. Every time, see, nobody wants to go in loss. They have come back. So they have taken the liquidity. Before that, they have taken care that sell stop loss have been created in the market. That is static liquidity again. Sell stop losses. Whoever bought thinking it as a support, what they will do, immediately they push the market and buy all the sell stop losses will be converted for their liquidity. And while pushing the market, another type of liquidity is created. That is, you can see there is a difference between this candle. See, every time when you see the candle, this wick, you can see it is going and touching, and here there is no gap. It comes down and it comes up. So there is no gap. But here in this candle, the big, huge candle, that is that is a huge candle. There is no transactions. Dynamic liquidity has been created. When such type of liquidity has been created, this is another way of observing the stop losses. So market tries to, the market in the big money tries to push the market to till the to absorb this dynamic liquidity. This is called as fair value gap. This is a gap actually. You will be seeing visible gaps here. You can see visible gap over here, not like this. You are not, this is an invisible gap which is present by pushing the market with a huge candle. So if you go on, now, from now onwards, try to observe these candles, what happens. See, then market has been, when they create rebalancing, dynamic liquidity has been created again. So the liquidity has been observed by creating the dynamic liquidity. So if you start seeing this dynamic liquidity after the sell stop loss, after the sell stop loss has been acquired, say when there is a dynamic liquidity, after this, it is mitigation. Mitigation means they have to, see when they have bought, put extra money, they have to, they should not go in what? They should not go in drawdown. So they are taking, big money is taking care of all those things, not to get go in loss. Nobody wants to go in loss. Big money, it doesn't want to go in loss. Now it has done like this, and again here no stop losses have been taken. Here you can see the money has gone down and there is no absorption. Even though there is dynamic liquidity has been created, it can be utilized later because it has gone down like this. So here you can see a dynamic liquidity has been created because of some sort of equal highs. Even though there is equal, they have not taken this, mitigated this. They have left it like that, and it has gone down. And dynamic liquidity, again, this dynamic liquidity has been created and it has been mitigated. So it has been filled. Now market has gone down again. There was a liquidity, dynamic liquidity over here, and it has been filled. So big candle and dynamic liquidity has been taken care of. So the money has come back and filled that gap because it is a huge candle. See, you can see equal lows. Let me zoom it out. Here in this area, almost equal lows. See, definitely somebody thinking that it will go up. Usually retailers trade in lower time frames. They do the mistake in this. For example, some scalpers will be there. If I change the time frame, yeah, here, see, this scalping, they will do it. So stop losses will be there, and this has been filled. Dynamic liquidity has been filled over there by creating the equal lows. So this liquidity has been taken care of, and the market, they have bought all the sell stop losses, and again the market created a huge this type of activity is done on and on. So now they are continuously going down. See, here they have mitigated everything. Here in this area there is no mitigation. So you can expect after some time, after taking any liquidity over here, probably we'll see here equal lows, and also there is fair value gap. If you carefully observe, there is a dynamic liquidity in this area. Gap is there. So they can come down and they will fill the gap, big money, because these are all algo trades. These are machine trades. They have been fed into the machine algos. They will recognize these dynamic liquidity and static liquidity very easily and very easily. Let me go to, yeah, I'll extend it to right so that we'll get levels. So that's why I was able to say these are the levels by identifying the dynamic liquidity. So dynamic fair value gap is there around 21,896 to 21,886. They may again come and fill this. They may gap down and they may fill this, and they have filled it. There is a gap here. They have not filled this gap. There is dynamic liquidity. After taking this liquidity, they may travel up to 22,140, 22,086 to 22,120, and even it can go up to 22,151. Like that, market functions. Actually, this is the problem with the big money, because they have huge money. If they want to sell, this is the game actually played by the big financial institutions, buying and selling, buying and selling. So market goes like that. Once the supply exceeds the demand, then market will go down. When the demand exceeds the supply, the market will go up. So that's how market functions. Otherwise, when it is not, there is no, this is the play between the demand and supply, and this type of play will be done, because it is not like us. It is for the big financial institution. Exchanging of the shares becomes difficult. So this is being created in the market, and retailers will have been taught for equal lows and equal highs, and also trend line liquidity. Even the trend line liquidity, they think it is a trend line. They will draw trend line. How many times you might have seen, you will draw the trend line, and when it gaps up, goes above the trend line, the market collapses and comes back into the trend line. You might have seen that is because of these retailers have been taught for this, and they go for buying trend line breakout, channel breakout, horizontal, level breakout. So how many times? For example, let me change the time frame to Google Alphabet. International American stock recently happened. See what happened in the market. Let me go to the daily time frame. Why it is not changing? Yeah, daily time frame. You can see it gapped up. It gapped up so heavily. Let me remove this drawing. Gapped up so heavily, and why it is coming down? Because this is the liquidity. They have to fill that. They have, so this is the breakout. So people, they do mistake by gapping up stocks, and they don't wait for the discount. See, this is how the market is played. Now, again, it will come down and fill this gap. That's how it will fill the gap. So otherwise, they will be in drawdown, because they have pushed the market higher. because of the news that it has given a very good result. Alphabet has given very good result, and now they push the market down, and halfway they have not filled the gap, and then they have taken this. See, they will do that in halfway. They will stop and they will taken this. Now it has gone up to this, and they will come back and they will take, because stop losses are created over here. Because of the turnaround, people might have gone again, new buyers have gone and they have bought it, but the market will turn down and it will fill the gap. There is the liquidity over here. Up to this, market can come down in this. Yeah, that's how we will see the. So immediately you should never go for breakout and wait for the discount, wait for this will be the play. So, but it is showing that demand, I mean, supply has exceeded the demand, but you need to wait for that. This is how dynamic liquidity, let me go back to the Nifty chart again so that you can understand what is dynamic liquidity and what is static liquidity. So probably this makes you clear about the functioning of the market. So the function for us, no problem. I can go, oh, I'm seeing the green candle. So this is a breakout. I can go and buy it. It's easy for me. Easily, if I want to buy, some seller will be there in the market because my quantity is very less. But for the big financial institution, remember that even if they want to bring the market down or the up, they need to be get charged. Charge means they should have there should be exchange of buy and sell sellers, then only they can get charged. Otherwise, they cannot do anything. So they cannot do anything. For that, a stage is set for creating static liquidity and also dynamic liquidity. Thank you very much, friends. Nalinakshi Swami signing off.